Good morning, everyone. We are about to discuss AFM pre-March 2025 mock exam and question number 2. So if I read the requirement, first requirement is calculate the APV adjusted present value for the project and evaluate whether the investment should be accepted or not. Show all relevant calculations. B part discuss the factors which will influence company credit rating, evaluating the extent to which these will be important to its shareholders. So in credit rating, it will be all you will discuss all the important points. For example, the profitability of the company. For example, you will discuss the industry factors. For example, the company positioning in the economy, and you will discuss about the financial gearing, operating gearing, and you will discuss about the management style. Okay, we will discuss the B part. So let me discuss the exhibit one by one. Uh, Fluftig company is a company that manufactures electronic parts and larger item of electronic equipments. Company profits have been steadily increased since it has incorporated and it has always kept its operating costs under control. It was listing on its local stock exchange 2 years ago. Fluftig company listing resulting in an increase in the number of shareholders with new investors including some institutional shareholders. In a recent meeting with the directors of Fluftig company, its institutional investors said that they were content uh, with its profit increase in the last 2 years, but wanted company directors to pursue investment in new products and markets to broaden its customer base and increase profit more quickly. Company board is considering how to finance future investment in the long term. Fluftig company CEO believes that the company should take advantage of listed status and issue loan notes. He understands that the terms on which the loan notes will be issued and the likely success of the issue will be determined by the company credit rating. He wants to understand the extent to which the factors that influence credit rating will be similar to the factors that influence shareholder opinion of Fluftig company and its management. So you will also discuss that the factors that influence credit rating are they similar to the factors which makes a shareholder opinion. Okay. Then the new product investment. Company board is currently considering proposal for a new investment in the communication units. Company board is currently considering proposal for a new investment in the communication units with immediate expenditure of 160 million. The investment will also require an immediate investment in working capital of 20 million. Working capital requirement can be expected to increase annually at the start of year 2 to 4 by the following expected rate of inflation. Working capital is fully recoverable at the end of year 4. Finance director has used a time horizon of 4 years and forecast the post-tax cash flows. Realizable value is 0. Equity issue. Okay, Fluftig company board is considering the following finance package. Equity issue 60 million, bank loan repayable in equal annual installment over project life. Interest is 8%. Okay, subsidized loan at a rate 50 basis point below the risk-free rate is 70 million. Issue cost of 2% of the gross finance proceed will be payable on the equity issue and on the subsidized loan. Company pays tax at a rate of 20% taxes payable in the same year. Company finance director intends to use the adjusted present value method to evaluate the investment financially. She has calculated the all equity finance discount rate 12%. You can also raise question on this how she has calculated 12%. So question seems to be very easy. So let's do the A part first, then we will do the B part. Hmm. So part A, adjusted present value. So let's divide it into two parts. Investment side, and then the financing side. The good thing is all the investment side is already solved. Almost. Almost all the investment side is solved. So let me write the years. Oh. Post-tax cash flows. Post-tax cash flows. 32.4, 52.7, 66.9, 56.4. Okay. Post-tax cash flows. Is there anything? No. Investment, 160 million. Working capital change. Yes, we can do the working capital change in working below. So let me write it. Okay. One thing more. All figures are in. All figures are in dollar million. Okay. सबसे पहले वर्किंग कैपिटल चेंज, वर्किंग कैपिटल रिक्वायरमेंट. Okay. In the first year, we need 20 million, year zero. Then it will increase with the inflation rate every year, 1.08. Next year, 7%. Next year, 5%. Okay. Then you will calculate working capital change. Okay, right? From the start of year two. From the start of year two is at the end of year one. This is from the start of year two, start of year three, start of year four. Whenever there is written that start of the year two, that is year one. Okay, you will write the year zero working capital as negative. Then you will calculate the change. Year zero minus year one and copy into the next cells. Okay, this is row number A19. So copy here. A19. Net cash flows. This plus this plus this. Now discount all the cash flows at ungeared cost of equity, that is 12%, I think. Ungeared cost of equity 12%. So base case NPV is NPV bracket start 12%, comma, select all cash flows from year 1 onwards and plus the year 0 cash flow. Okay, this is the value. It's negative 13.63. So base case NPV is negative. Okay. Now we will do financing side. Financing side. Although it is visible, but I can't solve this. You have to You have to see this screen only. Okay. Funds required for year zero investment, 180 million. Okay, 180 million. How many funds required from each side? That is given in the question. There is no there is no need of writing it again. So let's calculate the issuance cost. Equity issuance cost. कितनी है जी? How much it is? 2% of the gross proceed. Okay, whenever gross proceed is given, what you will do? 60 into 2 divided by 98. This is 1.22. Whenever gross proceed is word is written, so you will take the gross up of the amount and then take 2%. And subsidize that. Issuance cost. What is the amount? 70 million. 70 divided by 98 into 2. 1.4. So total is this. Okay. Now let's calculate the tax shield. There is no issuance cost on the debt. Only equity issues and subsidized loan. That is written in the question. Okay, let's calculate the tax shield on normal loan. Bank loan. Okay. The problem is bank loan is being payable in 4 equal annual installments. So bank interest rate is how much? 8%. Bank tenor is 4 years. So equivalent payment each year. So what you will do? You will divide it. You will divide the loan amount with the annuity factor. So let's calculate the annuity factor first. 1 minus 1 plus 8% raised to power minus 4. Okay. Divide by 8%. So this is annuity factor. So loan amount कितनी है जी? What is the loan amount? 50 million. So equivalent amount is this. 15.09. 15.10 approximately. Okay. Now let's calculate. Now let's make the table. Let me copy the years. First of all, opening balance. Then we will calculate the interest. Then we will pay the equivalent amount. 15.10 every year. Okay. Then we will calculate the closing balance. Then we will calculate tax savings on interest. So opening balance is 50 million. Interest is 8% into 8%. Closing balance. Opening balance plus interest minus the payment. And next year opening is the previous year closing. So copy into the next cells. Copy into the next cells. Copy into the next cells. This is approximately 0. Okay. So tax saving on interest is 20% of the interest. Now present value of tax shield. You will calculate the present value either at KD or risk-free rate. So it's up to us. By the way, what is the risk-free rate? Let's calculate at 3.2%. PV 3.2% bracket star comma. Select all cash flows. So this is the present value of tax shield of the subsidized debt. 1.95 approximately. Okay. You can also discount at 8%. It's up to you. Okay. Now subsidized loan. So loan amount is tax savings. Guys, loan amount is 70 million. Okay. We did the grossing up only for the issuance cost. We will take the loan 70 million. But we did the grossing up of 70 million just for the issuance cost. Why, sir? Because it is written in the question. Balance outstanding at the start of each year means the previous year closing balance and this year opening balance. Okay, 70 million into how much interest you are paying? Let me calculate. Subsidized interest. 3.2% minus 0.5%. Okay. So tax savings 50 million into 2.7% into 20%. 0.27. So let's calculate the annuity factor at 3.2%. 1 minus 1.032 raised to power minus 4 divided by 0.032. This into this. Okay. This is your present value of tax shield. Then next, present value of after tax interest savings. As taxes in the same year, na? So how to calculate this? You can directly do in one line or after tax interest savings. So loan amount is 50 million. If you want to Borrow from the bank, you could have get at 8%. Now you are getting the loan at 2.7% into 0.8. So annuity factor is we have already calculated above. So 7.84 is the present value of tax saving. So now APV, base case NPV is negative. Then issuance cost, then tax shield, okay, where is the second tax shield? This one. Okay, issuance cost is 2.65. Okay, this is present value of tax saving, after tax interest savings. So now let's calculate the total basis NPV minus issuance cost plus present value of tax shield and plus present value of after tax interest saving. It is still negative. Guys, if someone can please confirm the answer. It is approximately negative answer. Please check. So APV is negative. Is it correct? Based on final result as APV is a negative number, Fluftig should not accept the project. However, Fluftig company should use should use other scenarios, should use scenario analysis to further analyze the project, because base case NPV is negative, but financing side is overall positive. There should be deep analysis on investment side. For example, how a discount rate 12% has been calculated there is no information given whether it has properly accounts for the risk of project or not. Okay. There can also be further analysis on the post-tax cash flows and project life as well. Project life as well. Project is not going concern after 4 years. What could be the reason why it is not operating till the perpetuity? Guys, whenever you are undertake any new business, your underlying assumption is your business will continue for the foreseeable future. But here in this question, you are closing your business after 4 years. Okay? If you consider the full life, project basis NPV would be positive. If you lower the discount rate, NPV can be positive, but you don't know actually. So you will critically evaluate this, write this. Okay, what else? There was another point. Board is considering how to finance the future. Okay. In a recent meeting with the directors, its institutional investors said that they were content with its profit increase in the last 2 years, but wanted company director to pursue investment in new products and markets to broaden its customer base and increase the profit more uh, quickly. So, what is the concern of the shareholders? Institutional investors said that they are satisfied with its profit increase in the last 2 years, but wanted company directors to pursue investment in new products and markets to broaden its customer base. So, you can also write this. Institutional investors want company to broaden its customer base and to increase profit and to increase profitability profits. So maybe by taking so maybe by considering perpetual life of this project will lead to increase the profitability and shareholders will approve it. Okay? You can write in this. So you have to do the proper discussion by considering the all aspects. Remember this. That's how you can do it. Now the B part is generic. What is B part? Discuss the factors that which will influence company credit rating. Okay, what are the factors which credit company should see while assigning you the credit rating? We can also write this because we are getting loan at a very lower rate. That's why financing side is uh, positive. Yes, you can write this. Okay. So what factors we can see? What factors credit rating will see? So let me write the headings. Then we will discuss. I think number one is profitability. Number two is capital structure. Okay. Number three is operations. Number four can be uh, what can be number four? Management style, industry, economy. The working capital will cover under the profitability and the under the operations. Okay, now you will write. These are the factors which is important. So let me write the few. Okay, the rest you can write under this guidance. Credit rating agencies will see the overall profitability profitability of the company, especially recent profits. If company is performing well in all profitability ability aspects, Love Tech company can get better rate. Okay, now you have to link it with the shareholders' point of view as well. Love Tech company shareholders, especially, you can write directly institutional shareholders. Shareholders are also interested in profitability and increase in customer base. However, it should be considered if Fluftig company takes riskier projects to satisfy demands of institutional shareholders, it may lower the rate. Okay, there is a conflict as well. Next is capital structure. Capital structure is how you finance your business. Okay, let me write this as well. Capital structure, capital structure means how company is financing capital on overall basis. This is maybe okay, credit rating agencies will assess whether company can pay back its loan and interest timely and will check all gearing and interest coverage ratio. If company is taking too much loan, too much loan, it may threaten threatens the better credit. Okay. This is in contradiction to shareholders' point of view. They shareholders may want to finance all projects mainly from debt to earn tax savings, to earn tax shield. Okay. So this is in contradiction. So if you have taken too much loan for crediting it, this is problematic. But for shareholder, it is good. If company gets the loan on easy terms, it will be beneficial for shareholders and rating agencies. It would be a concern if debt holders, if the lenders, if lenders apply certain restrictions or covenants. Okay. You have to explain every heading here. Now you will discuss about the operation. In operation, you will discuss that rating agencies will see that how much company has a fixed cost. If company has a higher fixed cost, that means company operating gearing is very high. That means company business is risky. Shareholder will also see the same point. If you have lower fixed cost in the business, so that means the company is less risky. Company has flexibility to manage everything. But if you have higher fixed costs, your business is risky. Then you will also discuss the management style. Management style or management means credit rating agencies will check what are the qualification, experience of the management. If the management is well qualified, well experienced, and they have managed the fluctuation, the volatility in the past well, so they will assign a better credit rating. This is exactly the same point which shareholder will also see. Okay, you will check what is the experience of the management. What in the past, when there is a problem, when there is a volatility, when there is a recession, how management has responded. If management has responded well, you will get a better credit rating, and shareholder will also trust on you. If the management has performed well in the past, you will get the better credit rating and uh, better credit rating and better shareholder response. Next is industry. Next is assessment of the industry in which the company is operating. If the Fluftig company, is positioned well in the industry, you're an integral part of the industry, industry is depending upon you, so that is a positive side. If you are operating in an industry which is growing, which has a demand in the industry, so that is positive, you will get a better credit rating. If you are part of that industry which is dying, which is falling, so that means you will not get a better credit rating. So both shareholders and rating agencies will see how how the company is in the overall industry. If the company is major part of the industry, you will better get a good credit rating. If the industry is growing, you will get a good credit rating. If the industry is dying, you will not get a good credit rating. So you have to assess the industry as well. No, no. Shareholder will want that company should finance more from debt because ultimately all the tax shield will transfer to the shareholder. Remember the Modigliani and Miller theory? Company should take more and more and more debt. What will happen? The market value of the company, of the business will increase more and more. That is the point. Got it? We can write the working capital investment plan as well. Yes, we can write. Last is economy. Credit rating agencies will also see the economy, overall economy, political factors, legal and regulatory structure, how those political, legal, regulatory factors are influencing the company. If the company is linked with the economy and it has the political, legal, regulatory factors are all influencing the company, so you will not get a good credit rating. All politically exposed company will not get a better credit rating. Operation mean nature of the operation, fixed cost and variable cost. And management style is you will discuss about the management. What is management? Their experience, their past track record, their performance, how they have responded to bad events in the past. How, for example, in COVID, how they have responded and dealt with the COVID time. You can write this as well. But in reality, it is not like that. No, sir. As per MM theory, like for layman shareholders who wants dividend, but at this point, as a, no, no, what layman shareholders, क्या था layman shareholders का? So everyone wants a dividend. If even I am the shareholder of many companies. I have invested in many stocks. I want that company should give the dividends. This is the primary requirement. But remember one thing: if my company is growing by taking more debt, and I don't have to inject anything, what will happen? Company profitability will rise. So I am not getting dividend now, but I will get dividend in future. When the company profitability is rising, when the company APV, NPV is rising, so my market value will rise. Okay? So market value, capital gain, you will get the capital gain. Lehman Brothers was a dying company. You can't you can't relate this to the Lehman Brothers. Okay? वो तो 2008 में क्राइसिस आया खत्म हो गए जब when the company is on the verge of bankruptcy तब तो shareholder will demand a dividend. Okay, please give me dividend. I will go from this company. Uh, Shareholder will prefer dividend now rather than capital appreciation later, as it is. And it depends what kind of shareholders you are. Depends because if I have invested many millions in stock market, and out of my portfolio, I have invested like 10% in the dividend paying stocks. Only 10%. Why? Because I'm young, because I'm earning from different sources. So I don't need dividends. I need that company should grow. Why I'm not investing in Coke, why I have invested in Nvidia, I want that company should grow. Company should grow by 10%, 20%, 30%, 40%, 100%, 200% every year. I don't want dividend. I want that company should invest that money over the period and increase its size. But if I if I would have been at 60 years, that then at that time I need dividend because I would not be earning from many sources. If I'm the institutional shareholders, for example, I'm running a pension fund, I need dividend to pay out the pensions. So it depends what kind of shareholders you are. सर हम भी इतना ही लिख सकते हैं नाम हाँ हाँ ये कम नहीं है दिस इज गुड I am not using the examiner wording. I'm using my own wording. I am using the plain English so that you guys can get the confidence. एग्जाम के इंग्लिश कैसे लिखोगे हाउ कैन यू राइट द एग्जामिनर इंग्लिश यू आर नॉट इंग्लिश एक्सपर्ट ना you don't have that much vocabulary. You got the point about the dividend. Yeah. Everybody loves the dividend, but if I get the dividend and the company is not doing anything, then my investment is dead. Let me give you one example. In Pakistan there is a company and it was a power plant. So what happened? Government cancelled their power plant license. It gave them the money. So now that company has billions of cash and they are distributing all the cash in one chunk to all the shareholders. So just imagine I'm the shareholder of that company. I will get a huge dividend this year. So I must be happy. But there is one concern. Company will not do anything in future. I will only get the dividend. That's it. If dividend is higher than my investment, then it is okay. Otherwise, if the company is paying a good dividend from other perspective, but I am not getting enough money. No? So if you are young investor, you will prefer companies that will appreciate in price. If you are old investor means aged investors, then you will go for dividend stocks.